Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing awesome. How are you?
I am doing fantastic as well. I'm always excited about our time together because you're sharing so much really important information about the importance of retiring comfortably and, most importantly, with a plan.
That's it. The plan is everything, right? It's, I joke with my kids all the time about, I have a 17-year-old son that drives, and I said, well, how'd you get there? He's like, I have no idea. I just took the GPS. Well, it's important to have your own financial GPS now, and I think that's what we provide. But it's funny, it's important to also know the mapping of how you got there. And what we try to do is get clients involved in that decision making. I think a lot of times, advisors will talk above their clients and confuse them with big words and so forth. And I think it's really important to prepare people. I always tell our clients that, if I ever get hit by a bus, I want to make sure you can, do this without me. And, that's what we prepare as if. Now, hopefully they don't leave, but, we try to prepare them for, making their own decisions.
Yeah,
so that they know how to ask questions, right?
Of course.
Yeah, I think it's super important.
That's so important. So let me ask you, in your experience, Stewart, is it still an amazing amount of people that do not have a true written retirement plan in place?
Yeah, I think, and there's different versions of these written retirement plans, and some people, have nothing whatsoever. But the way we do it is we keep a very, very, very detailed cash flow analysis of our clients. We take a look at their income coming in, what they're expected to need in retirement, or if they're already retired, how is this asset going to compare to, this asset? We see clients that just have no idea whatsoever where they are or where they're going, and it is important.
Sure.
I mean, I ran across some phenomenal clients the other day. I just loved having them in my office, and they've got millions of dollars, but they had all of these carry forward capital losses. And what that is that if you buy an investment, you lose money in it, you can deduct that capital loss if it's a long-term loss, against dollar for dollar against capital gains that are long-term. But if you don't have capital gains, you can only use $3,000 a year to offset those losses, against ordinary income. Well, I had a client with $2 million of, capital loss carry forward, these big losses of the past. And, he came to me saying, hey, you know what, if we're not talking about dividends, we're not doing business. And I said, well, I don't think it makes sense in your situation, right? Not entirely. Because if you can take capital gains tax-free, because remember, if you take a growth approach and you just sell off your growth positions and offset that against the losses, they wash each other out tax-free. But if you're chasing dividends, when you have all these capital losses, you're never going to get to use those capital losses. So it's really important to look at the whole picture. And I think that, listen, advisors try to do the least amount of work necessary to, keep their job, right? Because they're so busy chasing down new clients. I think it's really important to keep them accountable, to make sure they are looking at every aspect of it. And if they don't look at your taxes, if your advisor doesn't analyze your tax return every year, honestly, it's time to get a new advisor.
Absolutely. Stewart, along those lines, let's talk a little bit today about market volatility. How do you help manage your clients' money during a volatile market time?
Well, the nice thing is that people realize that I'm spending my day all day long hanging out with my clients, right? All day long. That's all we're doing is creating plans. What we use are some of the best institutional money managers in the world. And when I say best in my opinion, we use who is arguably the biggest money manager in the world for one of our portfolios or one of our sets of portfolios. And then we have an algorithm portfolio that's basically a risk management portfolio. And it's not the guy down the hall that's doing a bunch of stock picks for you. If you're dealing with an advisor who is the guy picking the funds himself, picking the stocks himself, or they have an in-house guy doing it, generally, I always say never hire anyone you're not willing to fire, and it's really hard to fire the guy down the hall. And the reason they do that is because it's less expensive for them, not for you, but for them. Where when they do it in-house, they pay a guy a salary and he's picking his, the stocks. And to us, it's really important to be accountable, to make sure you have access to the best portfolios in the world. But what we do is, in one of our portfolios, we actually, have divided up between kind of a tactical and a passive approach. And most people have what we call a passive approach. And what a passive approach is, typically, is where, it's a standard portfolio where people say, I'm a 60% equity, 40% bond kind of family, or we're a 70-30 or, 60-20-20, with a cash component or whatever. Well, that's really easy for advisors to be able to handle. Why? Because all they have to do is their computer program once a quarter basically just reallocates into that same 60-40 split or 70-30 or whatever, right? It's a hands-free cruise control thing for the advisor. Very little work involved. And especially when they have an in-house, money manager that does that, it really takes all the burden off doing any real tactical work. Now, what a tactical money manager is what we use in all aspects of what we do. And one of our tactical money managers basically has identified 6 very distinct stages in the economic cycle. And, just use your logic here. If we're in a recession, there are different investments that will do better in that environment than if we're in expansion, right? So you have to be able to identify where we are in those stages. And right now it's really confusing, right? Like it's very difficult for the individual to figure out, hey, are we going into recession? Or are we not? But with this tactical approach here, we've identified these 6 distinct stages, and the algorithm determines where we are. That's just basically a supercomputer program that dictates where we are in that environment, and we can invest accordingly. And when I say we, I'm talking about our money manager. It's not me behind the computer. You don't want me picking your stocks. I'm too busy hanging out with clients all day long.
Exactly.
We want the best in the world watching, not just me, and I think I'm a pretty darn good planner, but you don't want me as a stock picker. I'm, it's not my thing.
Right. Well, that makes total sense to me, Stewart. Absolutely. Well, I think we're getting very close to the time where we're going to open up the phone lines. Do you want to tell the viewing audience what they can expect to receive by calling in this week?
Yeah, absolutely. If you call 833-652-7829, what we'll do is offer you a complimentary portfolio analysis and review to give you a second opinion on what your current portfolio looks like. We'll tell you whether or not we believe you're being treated in a fiduciary manner. We'll show you any expenses or fees that are built in or hidden inside your portfolio, and we'll show you what kind of risk you're actually taking. A lot of people are just completely disconnected with the risk that they're taking. So just call 833-652-7829. Get out of that couch, get up and make a call. We'd be glad to help.
Stewart, thank you so much. To the viewers at home, the phone lines are now open. That number to call is 833-652-7829. As Stewart mentioned, let him take a look at your portfolio. Have a complete portfolio review and analysis to make sure it's the proper portfolio for you for your retirement years. You deserve to have peace of mind. Again, the number to call is 833-652-7829. We have to take a very short commercial break. When we come back, I'm going to have some more questions for Stewart about how to plan your perfect retirement. Please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today, and obviously talking a lot about tactical versus passive styles of management. Let me ask you, in your opinion, why aren't more advisors using the tactical approach?
Well, because it's just more work. You know, I've said before, you know, brokers and advisors, you do the least amount of work necessary to get paid. And you know, they try to set these accounts on cruise control so it doesn't take a lot of work. Well, especially if they're dealing with it, like I was talking about earlier, in-house, right? If you have an in-house money manager, it's a lot of work to really, you know, analyze all of these things simultaneously. And that's why each of our money managers, you know, have tons of employees that are overseeing these portfolios. It's really important. You know, I always joke about with my clients that, hey, if I'm sitting with you all day long, what if, you know, some world event, you know, Kim Jong-un decides to invade, you know, South Korea, right? And the markets start tumbling. Well, what am I going to do about that? Am I going to say, hey, hold on one second, let me go ahead and call 600 of my clients real quick and make some trades? Well, no, of course not, right? That's why we have some of the greatest money managers, in my opinion, in the world that are overseeing our portfolios to make sure that you have the best access to risk management. And the reason others don't do it, it's expensive for them, like I said, and it's a lot of work.
Stewart, let me ask you, why wouldn't someone just invest in an index fund, if you will?
Right, so that's kind of the opposite of it, right? Where they're just saying, hey, you know what? I'll forget paying anybody. I'm just going to go into the S&P fund. And listen, that would have been a good bet this year. But what about, you know, when COVID hit, right? You would have taken the full brunt of the force of the market. And the problem is that most people don't have the, you know, the gall to be able to hang in there, right? So when in February and March we saw the market down 32%, you have no idea how many clients we had that were calling in saying, hey, get me out of the market, get me out. And the market's down 32%. I said, yeah, but look at your portfolio. Remember, in our tactical approach, you know, our tactical conservative account was only down about 7%. Our moderate account, which is one of our big accounts, was only down 10. Right? Or it was technically 9.6 from peak to trough. So a lot of times, you know, you first have to understand what kind of risk are you really willing to take? And I think that's why it's really important to do a portfolio analysis to understand where you are, because the neat thing about our software is that we can back test, we can, you know, forecast, we can replicate, you know, past scenarios, all those things, and say, hey, how much are you comfortable losing? If the market takes a dive, what are you comfortable losing? Because what we were seeing during COVID is all these clients that were so scared. And when I say during COVID, I know COVID's not over, right? Every time I say during COVID, I'm talking about the, you know, the market crash of COVID in February and March. I get tons of clients that say, hey, it's still going on, and you know, I get it. But what we're talking about is when the market was crashing, and what happens is people that are individual investors, they get out of the market and don't have a plan for reentry. They don't know when to get back in.
Yeah.
And that's why it's really important to disassociate the emotions from it, right? So if you have an S&P 500 fund, you lost almost a third of your value just in February and March. And, you know, if you actually had the guts to stay in there, you know, which most people, you know, didn't, or a lot didn't, you know, then you never regain that big V-shaped recovery. But remember, who the heck saw $3 trillion of U.S. government funds being injected? You can't plan around that.
Sure, it's true.
That's why we had that tremendous, you know, V-shaped recovery.
Yeah. Absolutely. Stewart, let me ask you, speaking of, you know, wanting to know how much you can afford to lose, on that same vein, do you recommend that people become more conservative with their investments as they approach the retirement years? What is your take on that?
Yeah, you know, it's interesting. The classical approach to conservative, moderate, balanced portfolios is just a shift from stocks over to bonds, right? But what we're seeing now is as people, we're in this interesting conundrum because most people don't own individual bonds anymore, and they buy bond funds. Well, if, you know, just remember, we are in one of the lowest not only are we in the lowest tax environment in history right now, we're in one of the lowest interest rate environments in history.
Sure.
And so if you go and buy a bond today, the 10-year Treasury's, sub 1% now, but if you go and buy a 1% Treasury bond, and next year, and you buy it for 10 years, which is what they're, most of them are issued for, you buy the 10-year Treasury, and it pays you 1% for 10 years. Well, what if next year the interest rates rise up to 2%, right? Well, what's going to happen to the value of your bond? Well, it's going to drop, of course, right?
Sure.
And so a lot of people are disconnected from the reality of where we are, and a lot of them don't understand the bond risk out there right now, right? It's not only the default risk of bonds, it's also the rising interest rate environment that we're facing, over the next few years that can, add some substantial additional risk into there. And, we've seen tons of clients that have these portfolios, and you'll look on their portfolio and you see a bond that says 5.6% for a corporate bond. And, it's an A-rated bond, it's a good quality company. And they're like, well, I'm making 5.6%. And then you look closely at the statement, and they didn't pay $100 for that $100 bond. They paid $130 for it. So they're making 5.5% on $100, not on the $130 they paid. And people just don't understand. There's a lot of trickery going on where advisors are buying up rates on bonds just so that it says 5.5 or 6%, even though that's not what they're making on their invested assets.
Wow.
Yeah.
That's not good for people that are in their retirement years, because you're balancing everything and you're focused on being comfortable during retirement.
It's just a red herring. It's a good way to distract from the real, yield of the account, because if you see it saying 5.6, you just assume that's what I'm making. But what happens if interest rates rise and those bond values drop?
I know.
In this low interest rate environment, you could be offsetting. I mean, literally the yield could be offset, by the depreciation in value.
Yeah. Whenever I hear you talk about that, Stewart, I imagine the teeter-totter.
That's it.
Going up and down, because that's exactly how you look at it with your value on the bond.
Yeah. Yeah, it's really important to understand the mechanics of your portfolio, and I don't mean using some big words to complicate you with this math formula. What we like to do is to really break it down into simple terms to help you understand what you have and how to plan for the risk that you're taking.
And that's a very good point that you bring up, because so often you have people that come in, I'm sure, with their portfolio for you to review, and they don't even know what they have or why they have it. Is that the case, Stewart?
Absolutely. I mean, one of the, most people don't understand the risk they're taking.
Yeah.
And, I ask the question over and over when I'm meeting with a client, and I'll say, Mrs. Smith, what are you comfortable losing if the market corrects? And they'll say, I don't know. What do you mean? I said, okay, well, you've got $500,000. What if the market loses $20,000? Are you okay with that? Yeah, I think I can handle that. How about $50,000? I don't know. How about 75? No, definitely not. So there's a pain threshold. Everybody has one.
Yeah.
Some people just have a bigger pain threshold than other people do, right?
Yeah.
It's important to understand what their risk tolerance is so we can know how they're going to react if the markets start pulling back. And the portfolio has to be designed around your specific risk tolerance, not my risk tolerance. I can handle it. I'm not worried about it. But if you're going to, toss and turn in the middle of the night because you're seeing a 5%, fluctuation in your portfolio, you need to know what's going to happen in these scenarios. And I think that's what we do really well, is we can demonstrate to you exactly what kind of risk you're taking inside that portfolio. And most people don't know.
Absolutely.
It's not only risk, it's cost as well. It's important to know what you're paying.
Absolutely, especially in the retirement years, because you don't want to be paying too much. That income needs to last for the rest of your retirement years.
Yeah, unless you want to go back to work again, and most people don't.
Yeah, absolutely. Well, Stewart, we're going to go ahead and open up the phone lines to the viewers at home. To the viewing audience at home, the phone lines are once again now open. That number to call is 833-652-7829. What Stewart is offering you today is a complimentary portfolio review. Let him take a look at what you currently have in place. Do you know the risk that you're taking? Do you know what you currently have as far as your stocks and what they're doing for you? Are they performing to the level that you need them to perform during the retirement years? Stewart has the answers for you. It's a complimentary review. Once again, the number to call is 833-652-7829. We'll be right back after this very short commercial break.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old, they've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
To the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show, obviously, that we're having today with so much information about planning for retirement. But I want to ask you a question, kind of stepping back a little bit. Let's talk about 401ks, because we're hearing a lot of people talking about they're having their company match the 401k. How much should they contribute? So let me ask you just point blank. Are 401ks a good idea? Why or why not?
Well, 401ks are a really important part of retirement for a couple reasons. If you're, under 59 and a half, I think it makes absolute sense. No question. You need to put as much as you can into a retirement plan as you can afford. Now, listen, you don't want to have to eat dog food to be able to, to live that way, to do that. But it's really important to make sure you have an appropriate amount saved for retirement. Now, what the 401k does is makes it very, very easy. Right? You just say, hey, I'm going to put away 6%, 8%, 15%, whatever your limits are that you can afford and that you're allowed to, you can put that away. But now what's really important is to understand the structure of what you should do. A lot of people don't realize whether they have a thrift savings plan or a 457B. We have a ton of clients here that are Arizona state employees that have these 457Bs, a lot of federal employees that have thrift savings plans. You now have a ton of different options. Like in the TSP or most 401ks, you can now contribute into a Roth 401k. Now, you're not going to get the tax benefits that you do up front of getting the deduction. But sometimes, people have put away all this money tax deferred because they think they're going to make less money in retirement than they do when they're working. And oftentimes it's just not the case, at least not for the people that have done a good job saving.
Sure.
Right? So it's important to have a structure to force that money away. But the neat thing is that once you turn 59 and a half, you have some choices. Most companies and most plans allow you to be able to do an in-service distribution, which will allow you to roll it over to have that money professionally managed by a company like ours. Now, it doesn't make sense in your case. Well, maybe not. You just have to look at the upsides and downsides, where your state of residence is, etc. But here in Arizona, a lot of people are deciding that they don't want to have to be blind and do it on their own. They want help. They want to make sure that somebody is watching it. A professional is watching the account all the time. And if you are 59 and a half years old or older, typically, you have a choice of whether or not you want to be able to roll that out of your existing plan. And I think it's really important to look. If you decide you want help to take a look at what your existing 401k offers, you just give us a call. If you call us at 833-652-7829, we would be absolutely glad to give you a second opinion on your portfolio.
Thank you, Stewart. We actually have a viewer question that came in regarding 401k. Is it okay if I throw it at you? I know you have no idea what I'm going to ask you. It says, Stewart, my husband recently passed away, and I would like to gift a portion of his 401k to our kids and grandkids. Is this a good idea so they can pay the taxes instead of me? By the way, I really enjoy your show.
Great, thank you so much. Well, I would just say that gifting directly from a 401k, see, if the spouse is the beneficiary of the 401k and she gives the money, like let's say there's $500,000 there and there's 4 kids, right? And the husband wanted to make sure it was split 5 ways between the wife and the 4 kids. And the wife was the beneficiary, but her job was to give it out to the kids. The problem is the wife would have to pay the tax bill and pay it in this big lump sum. If you decide, hey, I want to make sure I give it away, there are more efficient ways to do it than that. But what we're seeing is people are retroactively doing it, or there's certain cultures that's just how it's done, right? You have a lot of clients, you know, on the Indian reservations that do that. That when the husband passes, he wants to make sure the kids are taken care of on first passing. Well, you know, there's better ways to do that. If you have substantial amounts of money saved, if you've got, you know, $150,000 or more saved in these 401ks, I would absolutely say give us a call and we can show you the right way to do it.
Absolutely. Well, Stewart, we are actually almost to the end of another great show. Do you want to tell the viewing audience what they can expect to receive by calling in today?
Sure. If you call 833-652-7829, what we'll do is give you a complimentary portfolio analysis and review. What we'll do is we'll take a look at all the expenses, all of the risks that you're taking in there. What we'll also do is take a cursory view of your tax scenario. If you bring in your tax returns, what we can do is have our analysts look at that as well, and we can take a look at any potential savings regarding your investments and your taxes and how they work together. We'd be glad to look. Just call 833-652-7829, and either myself or Judd, my partner, would be glad to sit with you. It's going to be one of the 2 owners you're going to sit with.
Which is such a blessing because everyone loves both of you. I've heard that from so many people that have come into the office. They really enjoy meeting both of you. So, Stewart, thank you so much. To the viewers at home, thank you for spending time with us again this week. We know you have a lot of questions about how to retire comfortably, so please keep the questions coming. Stewart and Judd love to supply the answers to you. The number is 833-652-7829. Again, thank you for watching. Be safe, be happy, be blessed. We look forward to seeing you back here again next week. Take care.